I've been at Downtown for about 10 years. I started there as a research analyst and eventually became co-director of investments and one of the general partners. And the strategy we had there was concentrated long only. We got to do very deep dives on the companies we look to acquire and generally hold them for long periods of time. So I've been there for 10 years. I decided to leave at the beginning of 2011 and set up my own fund. And the reason for that was I'd always wanted to start my own investment business, and I felt that there were some things that could be improved upon and that had a more, I could put my own style. Downtown had been around for 35 years and had a very fixed process and philosophy and strategy, and there were some tweaks to it I felt I could make. So to go into that, the core of Anthology, I'm very much a value investor at heart. I believe all investing in equities, when done properly, is value investing, and growth is a part of value. So I look to hold a core group of stocks long and in a concentrated way, so maybe 10 to 20 securities, and a more diversified group of stocks short. And the differences between the two, the core group of stocks that I hold long are generally high quality businesses. They generate good returns on invested capital, have good capital turns, high margins, hopefully some recurring revenues, and are run by very capable and honest management teams. And I generally look to purchase them during periods of distress. Either the market is acting haywire like in 2008 or 2002, and things are just being indiscriminately sold, or it could be a company-specific issue that the market overreacts to because they have a very short-term time horizon, and yet the core problem is not really cut to the competitive advantages of the business. It's very temporary in nature, and it's a matter of trying to figure out what is the nature of the problem that this company is trying to address and face, and do I think they can kind of get past it in the long run. So that's the core long portfolio. The short side is more diversified, and those tend to be more competitively disadvantaged companies, generally found during the process of looking for good longs. They tend to realize that not every company that you look at is great. Some of them are actually quite terrible. And then the other set is frauds and potentially potential frauds, companies that have aggressive accounting and fads and overvalued equities. So.